All right, let's dive into the fascinating and notoriously volatile world of Tilray Brands Inc., TLRY. The stock is currently trading around 1.47, reflecting a significant intraday climb that's part of a much larger, more recent surge. This isn't just a minor blip, it's a powerful rally that has seen the stock more than double in the past month. This kind of explosive movement is a direct result of a fundamental shift in the market narrative, but also a stark reminder of the underlying volatility that has always defined the cannabis sector. The immediate catalyst for this recent price action is the renewed optimism surrounding U.S. cannabis regulatory reform, a perennial driver of excitement in this space. But to understand Tilray, we have to look past the short-term news cycle and analyze the broader, more complex picture of its multi-pronged business strategy. The most recent earnings report, specifically for the second quarter of fiscal year 2025, ending November 30, 2024, provided a mixed but intriguing look at the company's financial health. Net revenue was up 9% year-over-year to $211 million. This growth, while not explosive, is critical as it highlights the success of Tilray's diversification strategy. The most impressive segment was beverage alcohol, which saw a robust 36% increase in net revenue. This confirms that the company's aggressive acquisition strategy, including the brands acquired from Anheuser-Busch, is beginning to pay off. Cannabis revenue, however, was a different story, showing a slight decrease to $66 million. This points to the ongoing challenges in the Canadian cannabis market, which is saturated with competition and burdened by regulatory hurdles. The company's adjusted net loss was a modest $2 million, a notable improvement from the prior year, suggesting that cost-cutting measures and operational efficiencies are starting to take hold. While Tilray remains an unprofitable company on a GAAP basis, the incremental progress toward profitability is a key indicator that management is executing on its strategic plan. The market sentiment around Tilray has always been a tale of two realities. On one hand, you have the true believers who are convinced that U.S. supplementation, federal legalization, is not a matter of if, but when. These investors see Tilray's large-scale cultivation facilities, strategic acquisitions, and extensive distribution network as a powerful foundation to capitalize on this eventual change. The recent surge, fueled by speculation that the U.S. Drug Enforcement Administration may reclassify cannabis from Schedule I to Schedule III, is a perfect example of this sentiment in action. Such a change, which would ease tax burdens and open up banking services, would be a game-changer for the entire industry. On the other hand, you have the skeptics and short sellers who point to the company's continued losses, its highly dilutive share count, and the fiercely competitive landscape. They argue that the promise of federal reform has been a siren song for years, and until it becomes a reality, Tilray's core business in Canada and Europe remains challenged. The stock's journey from its multi-hundred-dollar peak to its single-digit valuation reflects the pain of investors who bet on a faster regulatory timeline. Analyst ratings on Tilray reflect this deep division. The consensus rating is a hold, with a wide range of price targets that illustrate the uncertainty. Recent upgrades have been driven by the reclassification speculation, with some firms like Jefferies raising their price target to 2, while others remain more cautious. The average price target is currently around 1.5, suggesting that analysts, even after the recent run-up, see limited upside from here without a concrete regulatory catalyst. It's a classic case where the fundamentals, as they currently stand, don't justify a significant premium, but the potential for a transformative regulatory event makes a strong sell rating difficult to justify. This is a story where the regulatory landscape is arguably more important than the company's financial reports. Diving into Tilray's financial health, it's a story of a company in transition. The balance sheet is a testament to its aggressive expansion. The company has a significant cash position and a manageable debt load, which has been crucial for funding its acquisitions. However, the recurring net losses and negative free cash flow raise concerns about its long-term viability without a change in the regulatory environment. Tilray has to continuously raise capital, which has resulted in a massive increase in its share count, a major source of frustration for long-term holders as it dilutes their stake and weighs on the stock price. The company's strategy is to use its diversified non-cannabis businesses, specifically its beverage, alcohol, and wellness segments, to generate cash flow and provide a hedge against the cannabis market's volatility. The growth in the beverage segment is a positive signal that this strategy is working, but it's not yet strong enough to offset the losses from the core cannabis business. Insider activity has been a mixed bag, which is typical for a company with a high profile and a lot of moving parts. There have been a number of planned stock sales by executives as part of their compensation plans. However, what has been more compelling is the consistent open market buying by key insiders, including CEO Irwin Simon. This is a powerful signal. When the person at the top, who has the most intimate knowledge of the company's inner workings, is putting their own money into the stock, it's a strong vote of confidence in the long-term vision. This buying activity, even as the stock was trading at multi-year lows, suggests that management believes the stock is undervalued and that their strategy will eventually pay off. The competitive landscape for Tilray is brutal. In Canada, it faces fierce competition from other licensed producers like Canopy Growth and Organigram, all fighting for market share in a mature and highly commoditized market. In the U.S., its non-cannabis businesses compete with established players in the beverage, alcohol, and wellness spaces, from major breweries to smaller craft brands. However, Tilray's competitive advantage lies in its global footprint and its unique, multi-pillar strategy. While most of its competitors are focused on just one market or one vertical, Tilray has positioned itself as a diversified consumer packaged goods company with a global reach. It has a significant presence in the European medical cannabis market, particularly in Germany, and a growing portfolio of non-cannabis brands. This diversification provides a level of stability and a broader addressable market that its pure-play cannabis competitors simply don't have. Looking ahead, the most critical factor for Tilray's future is U.S. regulatory reform. The ongoing reclassification discussion is a major overhang and a key driver of stock performance. A move to Schedule III would be a watershed moment, as it would not only reduce the tax burden under Section 280E, but also open up a massive and lucrative market for Tilray's products. However, investors need to be cautious. The political and regulatory timeline is unpredictable, and promises have been made and broken before. This is a stock for long-term investors with a high risk tolerance who believe in the eventual maturation of the global cannabis industry. The company is actively working to diversify its revenue streams, cut costs, and improve margins, but the cannabis market is still the primary driver of its valuation. Tilray is not a buy for the faint of heart. It is a speculative play on a regulatory event that, while increasingly likely, is not yet guaranteed. The stock's recent performance has been exhilarating for bulls, but they must remember that the path to profitability is still a long and winding road, and the road to sustained, long-term success will be defined by its ability to execute on its diversified strategy while navigating a constantly evolving regulatory environment.